Hello friends, a very good day to all of you and hope you all are doing fine. Over the next few minutes, we discuss some of the key events of the recent past related to the Indian equity market and also present our views on the market outlook. The Indian equity market movement during the past month remained quite subdued. However, the large cap stocks continued to outperform broader market counterparts. The Nifty 50 index went down by about 2%, while the broader market was even weaker, with small cap segment registering a cut of 3.6% during the previous month. Market breadth, as measured by advanced decline line, declined further on a month-on-month basis during February. India outperformed emerging markets by about 2 percentage points in the month, trimming year-to-date underperformance to 8.4 percentage points. While the macro concerns on elevated levels of inflation across the globe and consequent interest rate hikes and their impact on economic growth continue, however, the trend of foreign outflows from Indian equities moderated during the month. Domestic equity flows continue to be strong, led by consistently increasing SIP flows. On the global front, most of the economies are reeling under the pressure of high inflation rates and subsequent interest rate actions, leading to weak consumer demand and significant slowdown in economic growth rates. Even in India, we have seen the real GDP growth rate slipping to 4.4% for the third quarter, largely led by consumption slowdown. However, over the medium term, Indian economy looks far more resilient and is expected to remain relatively stronger as compared to the global growth rates. Corporate earnings were below our expectations during the third quarter, dragged by commodities, while financials and autos held the fort. Broad-based slowdown in consumption, both staples and discretionary, also hit corporate earnings. However, the spread of earnings was decent, with more companies meeting or exceeding street expectations. Most of the banks have guided for a sustained momentum in loan growth, powered by continuous traction in retail, business banking and SME segments. Corporate segment is witnessing a healthy recovery driven by working capital loans and healthy pipeline of sanctions. The commentary for the consumer sector indicated continued weak rural demand, but most of the companies also stated that there were some green shoots on rural consumption towards the end of the quarter that persisted into the calendar year 2023. There was also hope expressed that the likely good Rabi harvest, along with a decline in CPI inflation, would spur staples demand, albeit gradually. Automobile volumes have recovered across segments except two-wheelers, supported by improvement in the supply of semiconductor chips and healthy demand momentum in the domestic markets. Passenger vehicle demand would sustain on the back of healthy order backlog. Government's push towards infrastructure along with stable freight rates is aiding demand for commercial vehicles. Two-wheeler industry is yet to recover fully, which is lagging due to weak performance of the entry-level segment bikes. Overall, we may see improvement in profitability margins over the next few quarters depending on inflation trajectory. As far as our portfolios are concerned, we continue to focus on economic recovery plays and consistent compounders that have room for higher than average market earnings growth as well as possible valuation re-rating. The sectors or segments such as large banks, industrials, auto, cement and chemicals continue to have overweight exposure across most of our portfolios. On the valuation front, currently Indian equities seem to be trading around fair value zone once again after the prolonged time correction for the past 6 quarters. While we remain positive on Indian equities, we also recognize that the current valuation levels do not leave much room for any negative developments or disappointments. The delivery of earnings on expected lines will be very crucial for sustenance of current levels, more so for mid caps and small caps. As far as how to go about investing in equities now, We believe that one needs to follow time-tested principles of regular investing and long-term focus. With expectations of continued volatility in the short term, we advise equity investors to make disciplined and regular investments with long-term focus and utilize periods of volatility to build on long-term portfolio at better valuations. We continue to be positive on the corporate earnings cycle over the next few years despite fears of disappointments in the immediate term. We advise investors to have a slight tilt towards large caps and look at mid and small cap strategies only from an overall cycle perspective and have an investment horizon of at least 3 to 5 years. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.